Annuities can be one of the most misunderstood words in retirement planning. Some people hear guaranteed income and think that's exactly what I need. Others hear annuities and immediately think fees, fine print, sales pitch. In the next few minutes, I'm going to explain annuities in plain English, what they are, the main types, the key trade-offs, and the questions you should ask before you ever consider buying one. Hi, I'm Bud Milligan, Certified Financial Planner and Wealth Manager with Milligan Wealth Management. Welcome to Your Financial Bud, our YouTube channel featuring weekly videos on important financial topics. Since this is the first week of June, National Annuity Awareness Month, I wanted to kick off the month with a quick Annuities One-on-One. Just a quick note, this video is educational. It's not individualized investment, tax, or legal advice, and it doesn't recommend any specific insurance company or product. Annuities are insurance contracts, and the details, the fees, the guarantees, and restrictions vary a lot by contract. Please read the actual contract and disclosures, and talk with a licensed professional about your situation before making any decisions. So, what is an annuity? At its core, an annuity is a contract with an insurance company. In exchange for a premium, you can pay either by lump sum or a series of payments. The insurer agrees to provide benefits that can include tax-deferred growth, guarantees, and the option to turn a lump sum into an income stream. Most annuities have two phases, the accumulation phase and the payout phase. During the accumulation phase, you're building value inside the contract. During the payout phase, you can take withdrawals, or you can annuitize and receive scheduled income payments, sometimes for a set period, sometimes for life. The reason annuities exist is simple. Retirement has two big unknowns: how long you'll live and what markets will do. Certain annuities are designed with a goal to help create an anticipated income floor so your essentials don't have to depend entirely on market returns. I like to teach annuities using two simple either-or questions. When does income start? And how is value credited? So when it comes to when income starts, we are looking at either immediate or deferred. When it comes to how the value is credited, you're considering whether you want fixed, indexed, or variable, and we'll talk about this in more detail. So let's talk about immediate versus deferred. In an immediate annuity, you deposit a lump sum and income starts soon, often within a year. Think, I'm retiring now and I want to take part of my savings and turn it into a pension-like paycheck. Next, let's talk about deferred annuity. This is where income starts later. You're typically building value first, and you choose if, when to turn it into income. Think, I'm planning ahead, and I may want income in 5, 10, or 20 years. Now let's talk about fixed, indexed, and variable. What's the difference? Well, a fixed annuity credits interest based on a rate the insurer declares, and it may include guarantees about minimum interest and/or guaranteed income options. It's an insurance contract, and it's usually designed for longer-term retirement planning, not short-term cash needs. Indexed annuities returns are linked to an index with rules. An indexed annuity is designed with a goal to credit interest based on the performance of a market index, like the S&P 500. But the amount credited to your contract is determined by the contract's formula, not by simply owning the index. Contracts may use things like a cap, a participation rate, or a spread, which can reduce what you receive compared to the index's raw return. And these products can be complex, so it's important to read the contract and understand how interest is calculated. Also, not all indexed annuities are regulated the same way. Some registered indexed annuities are treated as securities and can expose you to investment losses, so you may receive a prospectus and additional disclosures. Either way, the math matters. And then finally, there are variable annuities. A variable annuity typically offers a menu of investment options, often similar to mutual fund-like portfolios, so the contract value can go up or down based on those investments. Variable annuities are considered complex products, and you'll usually receive a prospectus that outlines investment options, fees, and features. Considering all of these options, keep in mind that some financial advisors and insurance agents or brokers may be limited in what they can discuss or manage based on their license. You may want to work with a wealth manager who is a CFP professional and licensed in multiple lines of products to make sure you get an opportunity to compare products. A financial plan can also help you look at various scenarios with those products to help you decide on which annuities you want to use in your preparation for retirement. You don't want to get locked into a 9 to 12-year contract with penalties for early withdrawals if you discover that you picked the wrong type of annuity. Now let's talk about some key terms, costs, and trade-offs to understand. If you remember nothing else, remember this: annuities aren't good or bad, they're simply trade-offs. And here are the big ones to understand. Surrender charges and time horizon. Many annuities are designed for long-term use. If you exit early, you may pay surrender charges. The takeaway here is to match the product's timeline to your timeline. Then there are withdrawal rules. Many contracts allow limited penalty-free withdrawals each year, but amounts beyond that can trigger charges. Then we have guaranteed income with conditions. Guaranteed usually refers to the insurer's promise, subject to the contract terms. Understand what's guaranteed, for how long, and under what conditions. Then there are riders. These are optional features like lifetime withdrawal benefits, which can add value for some people, but they often cost extra and have special rules. Also, there are fees and complexity. Variable annuities in particular can have layered fees. Indexed annuities can have complicated crediting methods. Complexity isn't automatically bad, but it raises the importance of understanding what you own. Now, taxes. While many annuities grow tax-deferred, you will usually pay ordinary income on your withdrawals. If you annuitize a non-qualified annuity funded with after-tax dollars, an exclusion ratio will typically determine the percentage of the withdrawal that is tax-free and the percentage that's taxed as income. Now, here's my before-you-buy checklist. Number 1, what problem is this annuity solving? Income, principal protection, tax deferral, legacy planning, or something else? When do I expect to need this money? And what are the surrender charges if I change my mind? How exactly is interest credited, especially for indexed annuities? What are the caps, the participation rates, the spreads, and can they change? What are the total ongoing costs and optional rider costs? Ask for a clear dollars and cents example. What withdrawal options do I have each year without penalties? What guarantees are provided, and what's the insurer's financial strength? How will withdrawals or income payments be taxed in my situation? Now, if you're watching this during Annuity Awareness Month and wondering whether an annuity belongs in your retirement plan, the right next step is a conversation, not a quick purchase. At Milligan Wealth Management, we help clients compare strategies side by side. What happens if you use an annuity for income? What happens if you don't? And how it affects your taxes, your cash flow, and your flexibility. If you found these insights helpful, please hit that like button and subscribe to my Milligan Wealth YouTube channel for more practical financial guidance. And if you have any questions or need further clarification, reach out directly. You can go to my website at milliganwealth.com, click on the plus icon to the left of the screen, navigate to the calendar icon, and schedule an appointment. We can meet in person, on the phone, or virtually. Until next time, I'm Bud Milligan, your Financial Bud.